50 years ago, a fund manager in Pennsylvania built an investment product around a single, almost embarrassing selling point. Nobody makes any decisions. No stock picking. No market timing. No brilliant analyst reading the tea leaves on your behalf. Just buy the whole market, hold it, and get out of your own way. Critics at the time called it Bogle's Folly. One called it un-American. Footnote 1. Today that idea manages more money than the active management industry. For the first time in history, passive funds now hold a majority of net assets in the entire U.S. fund market. Footnote 2. It became the single most recommended, most sensible, most boringly correct piece of investment advice in personal finance. Here's the thing. Somebody still has to vote at every company's annual shareholder meeting. Director elections. Executive pay packages. Mergers. Climate resolutions. Every single one of those votes still gets cast by somebody on behalf of every share in every index fund. Tens of millions of people decided collectively to stop making decisions, and the decisions did not go away. They went somewhere. This episode is about where. The mechanics. Here is what an index fund mechanically is. A basket of securities constructed to replicate a benchmark, the S&P 500, the Russell 1000, the total U.S. stock market, weighted in most cases by market capitalization. There is no manager picking Exxon over Apple based on a read of either company's prospects. The fund buys both in proportion to their size because both are in the index. That is the entire investment thesis, and it is also the entire product. Here is what it is not: a decision-free product. It only feels that way from the investor's chair. Every share of stock a fund holds comes attached to a vote, and every vote has to be cast by someone. Annual meetings still happen. Directors still get nominated or not renominated. Executive compensation packages still go up for a say-on-pay vote. Merger proposals, shareholder resolutions on emissions disclosure, activist campaigns to break up a company, all of it requires an actual ballot, cast by an actual entity holding actual shares. The index fund doesn't opt out of that process. It just centralizes it. And it has centralized hard. As of the most recent fund flow data, passively managed funds account for more than 55% of total net assets in the U.S. fund market, up from 53% the year before. A share that has climbed essentially every year since 2005 for equity funds specifically, without a single year of reversal. Footnote 3. Vanguard alone manages over $35 trillion in assets, a 28% share of the entire U.S. long-term fund market on its own. Footnote 4. Add BlackRock's iShares and State Street Global Advisors, and you have arrived at what the corporate governance literature, without much affection, calls the Big Three. Footnote 5. Bebchuk and Hurst at Harvard Law School and Boston University's Law School respectively, ran the numbers in a 2019 paper with a title that reads like a warning label: The Spectre of the Giant Three. Footnote 6. What they found: the Big Three's combined ownership stake in S&P 500 companies has very nearly quadrupled over the past 2 decades. Each of the three now holds 5% or more of the shares outstanding in a genuinely enormous number of public companies, the threshold at which a shareholder has to start formally disclosing its position to the SEC. Footnote 7. And across S&P 500 companies broadly, the Big Three collectively cast on average about 1 in every 4 votes at the annual meeting. Footnote 8. None of this required anyone to do anything wrong. Every one of these funds is legally required to vote in what its stewardship team judges to be its client's best interest. Footnote 9. The mechanics are clean. The concentration is just a side effect nobody priced in when the product was designed to be, above all else, the thing that required no thinking at all. The evidence. Start with the contrasting pair. On one side, the Big Three's combined ownership stake in S&P 500 companies has nearly quadrupled since the early 2000s, and each firm now holds meaningful voting positions across virtually the entire large-cap public market. Footnote 10. On the other side, the number of dedicated research analysts each firm employs to individually evaluate the investment merits of any one of those companies is, relative to the scale of ownership, close to irrelevant, because the entire premise of passive management is that nobody is supposed to be doing that evaluation in the first place. That's not a gap in execution. That's the product working exactly as designed. Ownership without evaluation, at a scale no actively managed fund in history has ever approached. Here's the human scale version. If a company's annual meeting is a room with 4 seats, 1 shareholder, 1 vote, then somewhere between 1 and 2 of those seats at almost any large American company you can name are now occupied not by an owner who chose that specific company, but by a stewardship team at one of 3 asset managers, voting on behalf of everyone who ever bought a target date retirement fund without reading the prospectus. That includes, statistically, most of you. Now for the part that should genuinely surprise you, because it isn't about voting at all, it's about pricing. A 2018 study in the Journal of Finance by economists Jose Azar, Martin Schmalz, and Isabel Tecu examined an industry where the same handful of institutional investors own large stakes in every major competitor, the U.S. airline sector. Footnote 11. Their finding, since debated, refined, and contested by other researchers, and worth stating with that caveat attached, was that ticket prices on routes with higher common ownership across competing airlines ran measurably higher than routes without it. The theory: when your 3 largest shareholders are also the 3 largest shareholders of your only real competitors, none of you have quite the same incentive to fight each other on price that you would if your ownership structures were actually separate. Standard antitrust law was built entirely around direct mergers between competitors. It has essentially nothing to say about this: 3 investors quietly holding meaningful stakes in every company in an industry, without a merger ever being filed. The regulatory apparatus built to police corporate concentration was designed for a world where concentration looked like one company buying another. It was not designed for a world where the concentration is the ownership structure itself, sitting quietly across an entire sector, never triggering a single antitrust review because, on paper, all the competitors are still legally separate companies. Why it stays this way? The obvious fixes all sound reasonable. None of them survive contact with the actual mechanics. Ban index funds from voting at all. Sounds clean. Except someone still legally has to cast a vote for every share outstanding. The fund can't simply abstain from its fiduciary duty because voting makes people uncomfortable. Removing the vote doesn't return power to individual investors. It just leaves a vacuum that gets filled by whoever's left in the room. Pass-through voting: let individual investors direct their own shares. This one actually exists. BlackRock launched exactly this program, called Voting Choice, in January 2022. As of mid-2025, roughly $3.3 trillion of BlackRock's $6.9 trillion in index equity assets was technically eligible to participate. Assets actually exercising that choice: about $784 billion, meaning even among the funds where this option exists, most clients simply leave the default in place. Among individual retail shareholders specifically, fewer than 30% typically vote their shares at all, even when directly invited to. Footnotes 12 and 13. The tool for returning the decision to individuals exists. Individuals overwhelmingly decline to use it. Break up the big 3 through antitrust action. There is academic literature making exactly this case. There is no live enforcement action doing it. And even if you did split BlackRock into 3 smaller BlackRocks tomorrow, you haven't reduced the underlying concentration of the passive strategy. You've just multiplied the number of intermediaries executing the identical index tracking approach. The concentration is in the strategy, not merely in the corporate logos attached to it. Push people back toward actively managed funds, where a human analyst is making individual judgment calls and, at least theoretically, voting with more individualized attention. This is the option that runs headfirst into the actual data. Over the 10 years through 2024, only about a third of active large-cap funds survived and beat their passive benchmark, and the odds get worse, not better, the longer you measure. Telling people to abandon the cheaper, better-performing option in the name of decentralizing corporate voting is asking most investors to voluntarily accept lower returns to solve a problem most of them have never heard of. And there's the locked room. Index investing is popular and demonstrably good for the people using it for exactly one reason. It removes the burden of decision-making and the cost structure that comes with paying someone else to make those decisions for you. That is not an incidental feature of the product. It is the entire product. Every fix on this list works by reintroducing some version of decision-making, engagement, or cost back into a system whose entire value proposition was removing it. Every door has a locked room behind it, and in this case the room is furnished with exactly the feature everyone bought the product to avoid. The design layer. The man who built this, John Bogle, founded Vanguard and launched the first index fund available to individual retail investors in 1976. The first index investment trust, dismissed at the time by competitors as a mediocrity machine, a way to guarantee you'd never beat the market because you'd never even try. Bogle's own summary of the pitch, later famous enough to end up on inspirational finance posters. Don't look for the needle in the haystack. Just buy the haystack. Here's the part that isn't a plot twist, because Bogle told everyone exactly what was coming in writing with his own name attached in the Wall Street Journal, on November 29, 2018, 13 years after his own invention first started actually accelerating toward the scale it has now reached. His words, not anyone's paraphrase of them. If historical trends continue, a handful of giant institutional investors will one day hold voting control of virtually every large U.S. corporation. He added, with the flat understatement of a man who had spent his career being right about fees, public policy cannot ignore this growing dominance. Bogle died 2 months after that piece ran. He did not get to see the Bebchuk and Hearst paper confirm his numbers empirically the following year, or watch passive investing cross 50% of the U.S. fund market a few years after that, or read the newest fund flow data showing that shares still climbing uninterrupted in the year we are recording this episode. We are not describing a surprise. We are describing a documented forecast, published by the one person with the most credibility to make it, completing itself roughly on schedule. The only sarcasm available here is the sarcasm of watching it happen exactly as predicted and still calling it news. None of this required a villain. Nobody at Vanguard, BlackRock, or State Street sat in a room in 1976 and planned to accumulate a quarter of the voting power at every major American company by the 2020s. The concentration is a mechanical consequence of an honest, popular, genuinely useful product scaling exactly as intended. That's a harder story to tell than a conspiracy, and a more useful one, because it means the fix, if there is one, has to work with the grain of a product people are right to want, not against it. And somewhere in that voting power is the answer to a question this series has been building towards since episode 2. Who, exactly, is approving the trillion-dollar buyback programs and the executive pay packages we've already shown you the mechanics of? The votes we just spent this entire episode locating are, in no small part, the votes that wave those programs through. Passive investing did not take power away from Wall Street. It relocated the address. The decision-making didn't disappear when tens of millions of people opted out of making it. It consolidated quietly into 3 stewardship departments most of those same people couldn't name. That's not a scandal. It's an architecture. And every architecture has an approvals process. Next time, the machine that architecture keeps approving at a scale of nearly $1 trillion a year, almost without objection.